the 5-year gift trap that lets Medicaid legally steal your home. That $50,000 gift to help your kid with a down payment, Medicaid can treat it like you hid money. That means denied long-term care, months, sometimes years without coverage, and pressure to sell your home to private pay during the gap. Here's the part nobody tells you. The IRS gift exclusion doesn't protect you in Medicaid. Different rule book. In the next few minutes, I'll show you how the 5-year look-back actually works, how the penalty is calculated, and the legal ways families protect the house. Stay with me, because there's an exception that can still save thousands even if you already gifted, if you move fast and document. The problem you don't see coming: why gifts trigger penalties. Long-term care is expensive. Nursing homes often run thousands per month. Most families can't private pay for long, so they plan to qualify for Medicaid when savings run down. Here's the catch. Medicaid checks your last 5 years, 60 months, 30 months for some home and community-based services in a few states for uncompensated transfers, also called gifts, and penalizes you for them. The intention doesn't matter. Helping with tuition, a wedding, a down payment, or just sending regular help to grandkids can all be counted as gifts. The thing most people miss is the difference between tax rules and Medicaid rules. The IRS annual gift tax exclusion is a tax concept. It doesn't say your gift is invisible to Medicaid. Medicaid asks a totally different question. Did you transfer something for less than fair market value? If yes, it's an uncompensated transfer. That's what triggers a penalty. Why does that matter? Because when you need care, Medicaid can delay eligibility for months based on the total amount you gave away in the look-back window. During that delay, you're expected to private pay. If you don't have liquid cash, you may be forced to sell assets, including your primary residence, just to bridge the gap. Families call this Medicaid taking the house, but technically, it's the penalty forcing you to spend privately until the penalty expires or you cure it. Let me ground this with everyday examples. You pay $12,000 for a grandchild's tuition. You gift $20,000 to help your daughter buy a home. You cover $5,000 for a family medical emergency. None of those have bad intent, but if they're within 5 years of your Medicaid application and there's no fair market value received in return, the total can create a penalty. Even transfers through apps like Zelle or Venmo count. So do for giving a loan without payment or selling a car to a relative for a family price. This clicked for me when I saw families who did everything right for taxes get blindsided during Medicaid review. They had spotless returns and thought the $17,000 or similar annual exclusion kept them safe. It didn't. Medicaid caseworkers look at bank statements, brokerage accounts, deeds, titles, and trusts. They ask for explanations. If the transfer wasn't for fair value, it's at risk. The reason this works this way is simple. Medicaid is means tested. The policy goal is to prevent people from giving away assets to qualify early. So the rules are strict. You don't have to agree with them, but you need to know them. Now, the consequences of doing this wrong are heavy. If you apply and they find $50,000 of gifts in the look-back, you can be ineligible for months. Meanwhile, the nursing home still needs to be paid. Families often pull from savings fast, liquidate investments at the wrong time, or borrow against the house. And if there's not enough cash, that's where selling the home becomes a real possibility, especially if you're single and no spouse is living there. Here's a quick win you can do today. Inventory the last 5+ years of transfers. List every non-routine payment to family or friends. Include checks, cash withdrawals, app transfers, wire transfers, loan gifts, and below-market sales. Add dates, amounts, recipients, and any documentation showing fair value or repayment. If you paid for services like caregiving, note whether there was a written contract and invoices. That paper trail can be the difference between a gift and a legitimate expense. Now, you might be thinking, do small holiday gifts matter? Some states may overlook to minimize routine gifting, especially if it's been consistent and modest compared to your income, but don't assume. Patterns help, surprises don't. When in doubt, document. Before we continue, you need to understand why tuition and medical payments can still be a problem. Unlike federal tax rules where paying someone's tuition directly might avoid gift tax concerns, Medicaid still frames it as a transfer for less than fair market value unless there's an allowed exception or it's clearly part of a regular, modest pattern consistent with your history and means. Again, state enforcement varies, but the risk is real. Assume it counts unless your state's policy explicitly allows it and you have proof. Here's the shortcut nobody teaches. Separate generosity from eligibility windows. Once you're within 5 to 7 years of possibly needing long-term care, stop casual gifting. If you want to support family, use formal compensatory arrangements where you receive fair value, things like bona fide caregiver contracts with logs and invoices, or formal loans with written terms and actual repayments. If you remember nothing else from this section, Medicaid doesn't care about gift tax exclusions. It cares about uncompensated transfers. Let me show you exactly how this ties to your home. Your primary residence can be exempt while you live there, and there are protections for a community spouse. But if you trigger a penalty, you may need cash to cover care until the penalty period ends. That's when families end up selling or borrowing against the home, not because Medicaid instantly seized it, but because the penalty forced private pay. Avoiding the gift penalty is often the most practical home protection strategy you can take once you nail the inventory and understand the uncompensated transfer concept. Everything else clicks. Next, we'll break down the 5-year look-back itself, what Medicaid checks when the clock starts and the transactions people forget to disclose that end up causing the most trouble. The 5-year look-back, what it is, and what Medicaid checks. Let's make the look-back crystal clear. When you apply for long-term care Medicaid, the agency reviews your financial history for a set period, typically 5 years, to see if you transferred assets for less than fair market value. That's the look-back. They're not judging your generosity. They're asking one question: did you move money or property out of your name without being paid fairly? If yes, that's a violation, and it can trigger a penalty. Here's where timing trips people up. The 5-year window counts backward from your application date, but the penalty doesn't start the day you made the gift. It starts when you're both medically eligible and financially eligible, and you've actually applied. That's why a transfer at 4 years and 11 months can be devastating if you file now, but the same transfer at 5 years and 1 month is outside the look-back and doesn't count. The start date versus application date difference is a big deal. You control the application date. You can't change the date of a past gift. What do they review? Expect to provide 5 years of statements for bank and credit union accounts, brokerage accounts, retirement distributions, and any accounts where your name appears as owner or joint owner. They'll look at property records, deeds, titles, transfers of houses, condos, land, and vehicles. They ask about trusts you created or benefit from, recent life insurance cash-outs, annuity changes, and any promissory notes. If you closed an account, they'll still want the old statements to see where the money went. Now, here's where most people mess up: digital and informal transactions. Transfers made through Zelle, Venmo, Cash App, or PayPal still show as outgoing payments on your bank statements. Caseworkers can and do ask what those were for. Cash withdrawals raise red flags if you can't document how the cash was used. Giving a caregiver gifts or stipends without a written contract and invoices looks like uncompensated transfers. Even a family discount sale, selling a car worth $10,000 to a grandson for $1, is a transfer below fair market value and is typically added to the penalty total. Once you nail that, everything else clicks. Medicaid isn't only hunting for big-ticket items, they're looking for patterns. A one-time $300 holiday gift might not cause a problem if it's modest relative to your income and you've done it consistently for years. But sporadic large transfers, new patterns of giving, or lump sums without clear consideration are likely to be scrutinized. The more organized your records, the easier it is to show fair value. Before we continue, you need to understand state variations. Medicaid is a joint federal-state program. The federal framework defines the look-back concept and the requirement to penalize uncompensated transfers, but the details can vary by state: what documentation they demand, how they treat partial months, the penalty divisor, whether HCBS uses a shorter look-back, and how aggressively they question certain transactions. Don't assume your sibling's experience in another state applies to yours. Use your state's rules as the baseline and plan to meet that standard. Here's the shortcut nobody teaches. Build a clean narrative. Create a simple timeline for the last 5 years listing major deposits, withdrawals, transfers, and property changes. For each, attach proof. Invoices, receipts, contracts, valuation printouts, settlement statements, and explanations. If you sold an asset, include a valuation to show it was a fair market sale. If you paid for services, use a contract and regular invoices. If you loaned money, show a signed promissory note, repayments, and bank evidence of those payments. Now you might be thinking, what about trusts? If you created a revocable trust, assets in it are typically still considered available to you. So transfers in and out aren't gifts in the Medicaid sense. They're still yours. With irrevocable trusts, it's different. Funding an irrevocable Medicaid Asset Protection Trust is a transfer for look-back purposes and starts the 5-year clock. That's not bad planning. It's expected planning. You just have to do it early enough and correctly, with no retained strings that make the assets countable or invite available resource treatment. The game changer nobody talks about is the application-ready test. If your state asks for 5 years of statements, be ready to produce them quickly and cleanly. Missing months, unexplained cash, and vague notations like help for family invite delays and denials. Organized documentation keeps your caseworker from guessing, which reduces the risk they classify something as an uncompensated transfer. And here's the payoff. Once you understand what Medicaid actually checks, you can prevent innocent transactions from becoming penalties. Keep receipts. Use contracts. Show fair value. If you remember nothing else, remember this. Every dollar out needs a story, and that story needs proof. The penalty period formula: how your gift becomes months of ineligibility. Now let's turn gifts into math, because this is where decisions get real. Medicaid doesn't guess your penalty. It calculates it. The core formula is simple. Total uncompensated transfers during the look-back divided by your state's penalty divisor equals the number of months you're ineligible for long-term care Medicaid. The divisor is just the average monthly private pay nursing home cost your state sets. Higher divisor, shorter penalty for the same gift. Lower divisor, longer penalty. Why this matters: 2 people can make the same $50,000 gift and get very different results depending on the state. If your state's divisor is $10,000, that's a 5-month penalty. If the divisor is $6,500, that's about 7.69 months. It's the same gift, but different months of ineligibility. That's why you never copy advice across state lines without checking the current divisor. Here's the part most families get wrong: when that penalty clock starts. It does not start when you made the gift. It starts when you're otherwise eligible, meaning you meet the medical level of care, your assets and income meet your state's limits, and you've applied. If you gifted money 2 years ago, the clock didn't start 2 years ago. It starts when you hit eligibility and file. Apply too early, and you trigger the penalty while you still have assets to spend. Wait too long, and you burn cash unnecessarily before the clock even starts. Timing is everything. Let me walk you through crisp examples so the math sticks. Say you gave $50,000 to a child for a down payment 36 months ago. You apply today. Your state's divisor is $8,000. 50 divided by 8 equals 6.25 months. In many states, partial months get counted to the day. In others, they round down or carry partials differently. That's a state-specific detail you need to confirm. But the point is, you're looking at roughly 6 months during which Medicaid won't pay. The nursing home still expects payment. Different state, same gift. Divisor is $9,500. 50 divided by 9.5 equals 5.26 months. That's about 5 months and 8 days in states that prorate by the day. Notice how the divisor changes your exposure by weeks. That's real money. Here's another nuance the pros track: cumulative transfers. Medicaid adds all gifts in the look-back. $5,000 here for a grandchild's car, $12,000 there for tuition, a forgiven $10,000 loan, and a family price sale that effectively gave away $8,000 of value, all stack. If the total is $35,000 and your divisor is $7,000, you've got a 5-month penalty. There's no limit where small gifts don't count. It's the sum that matters. Now, partial months and rounding practices. This is where state differences bite. Some states round down to whole months, which can slightly reduce your penalty. Others calculate to the day. A 6.25-month penalty becomes 6 months and about 8 days, 0.25 of the current monthly divisor. That affects how much private pay you need to plan for and how you coordinate your application date, move-in date, and any cure strategies. Before you file, ask your elder law attorney how your state handles partials. Build your plan to the rule, not your assumption. Let's anchor the when the clock starts mistake with a micro story. A client applied while still holding $20,000 above the asset cap, thinking approval would just catch up when they spent down. The state approved medical level of care, but imposed the transfer penalty immediately. They then had to spend down the excess plus cover private pay for the penalty months. If they had spent down first on allowable items like dental work, hearing aids, home safety upgrades, and applied when they were financially eligible, the same penalty would have run during a time when they had fewer assets to drain. Now here's the game changer nobody talks about. Strategic cures can reshape this math even after you apply in many states. If the recipient returns part or all of the gift, the penalty recalculates on the net uncompensated amount. Using our $50,000 example with an $8,000 divisor, if $20,000 is returned, the new exposure is $30,000 divided by $8,000 equals 3.75 months. In states that prorate, that might save you nearly 2.5 months of private pay. But timing matters. Returns need documentation and must be accepted by the agency to count. Common mistakes to avoid right here. Assuming the IRS gift exclusion protects you. It doesn't. Assuming a one-time gift under some threshold is safe. There isn't one. And filing without the divisor number. Your entire cash plan depends on it. Also, don't forget non-cash transfers. Deeding away a remainder interest in your home without fair value is still a transfer. So is canceling a loan without collecting. So are in-kind gifts to caregivers when there's no contract and no invoices. Let me give you a quick win you can act on today. Call your local Medicaid office or check your state agency website for the current nursing home penalty divisor. Write it down. Then sum your suspected uncompensated transfers from your 5-year inventory and divide. That rough month count is your risk number. Bring that to an elder law attorney. You'll skip the first hour of guesswork and go straight to strategy. And here's the payoff. Once you can translate dollars into months, you can make smart moves, delay filing to pass 5 years on a big gift, arrange a partial return to shave months or time your spend down. so the penalty runs when you're already at asset limits. This turns fear into a plan. The timing traps, why will apply after 5 years, backfires. Let's tackle the plan I hear all the time. We'll just wait 5 years and then apply. Sounds clean, but here's where it breaks. Life doesn't schedule care needs around a calendar. If you need nursing care at 4 years and 10 months after a gift, filing now triggers the penalty. Waiting 2 months to cross the 5-year line might seem smart, but how do you pay for care in the meantime? That gap often forces expensive private pay, which can burn through cash or push a home sale. Now, gifts inside 5 years versus outside 5 years. Outside is clean. Those transfers aren't part of the look back and don't count. Inside is contaminated, they're added up and penalized. The trap is assuming you can thread the needle. If your health turns quickly, you may need to apply before you hit the 5-year mark, and the penalty lands exactly when you're most vulnerable. That's why planning around a precise anniversary date is risky. Here's where staggered gifts make it worse. Many families give in pieces. $10,000 one year, $5,000 the next, $20,000 later. Medicaid aggregates them. There's no per year forgiveness. That pattern can stretch your penalty months because there's more to tally and the most recent gift starts later on the calendar, making it harder to wait everything out. Applying too early versus waiting too long is another minefield. Apply too early, and you might still be over the asset limit. The penalty starts when you're otherwise eligible and you file. If you've got excess funds at filing, you'll burn those down while also covering the penalty period. On the flip side, wait too long and private pay costs stack up before the penalty clock even starts. You could spend 6 months draining savings only to apply later and still face the penalty for past gifts you didn't cure. Let me show you the private pay math during a penalty. Say your penalty is 6 months and the facility costs $8,500 a month. That's $51,000 of private pay exposure. If your liquid assets are $30,000, you're short by $21,000. That shortfall is where families turn to home equity, selling or borrowing against the house, to plug the gap. This is how Medicaid takes the house plays out in practice. The penalty forces private pay, and the home becomes the piggy bank when cash runs dry. The application date mistake is huge. People file hoping to get in line, planning to clean up assets later. But your state won't let benefits start until you're actually financially eligible. If you file incomplete or ineligible, you trigger review without running the penalty clock strategically. The smarter move is to prepare eligibility first, spend down on allowable items, fix documentation, line up proofs, and file when the numbers already meet the limits. Then the penalty, if any, runs while you've minimized assets at risk. Now, here's the game changer nobody talks about, the coordinated spend down window. Instead of waiting 5 years and praying you won't need care, build a timeline that aligns 3 things: meeting asset limits, having a bed available, and the penalty period you already calculated. If you know you face a 4-month penalty, plan the last stretch of spend down. So the penalty starts exactly when you're financially eligible and placement is ready. That avoids paying extra months privately before the clock even starts. Common timing mistakes to avoid right now: making a last small gift just months before filing. It stacks and extends the penalty. Moving assets to kids during a crisis. Those transfers are discoverable and penalized, and counting on verbal caregiver arrangements. Without a written contract and logs, those payments can be reclassified as gifts. A quick micro story. A family waited to apply until they crossed the 5-year mark on a big gift, but they'd made a $7,500 bridge gift 8 months prior to help a grandchild. That single recent transfer dragged their application into a new penalty. If they had known, they could have had the grandchild return the funds and cured it before filing. Timing plus knowledge would have saved thousands. Here's your takeaway action. Stop the "we'll just wait 5 years" plan unless your health and finances can realistically support that wait. Instead, map your suspected penalty, lock in your state's divisor, build a clean spend down, and line up cures or returns before you file. When the math, paperwork, and application date move together, you control the timeline instead of the timeline controlling you. You're home, protected, exempt, and still at risk. Let's talk about the house, because this is where people feel blindsided. Your primary residence can be an exempt asset for long-term care Medicaid, but exempt doesn't mean untouchable in every situation. Think of it as conditionally protected. If you meet certain criteria, the house doesn't count against your eligibility while you live there. That helps you qualify. But other rules can still put the home at risk later, or force you to tap its equity during a penalty period. Here's the basic rule. For many states, your primary residence is exempt up to a home equity limit that changes periodically and varies by state. If you live in the home, or you can reasonably intend to return, Medicaid typically doesn't count it as a resource for eligibility. If you're married, the community spouse can stay in the home and it remains exempt for their lifetime, regardless of your care setting. That's powerful protection. Now, here's where most people mess up. The exemption can stop applying depending on who lives there and what happens after you qualify. If you're single and you move permanently into a facility without a realistic intent to return, some states treat the home as a countable resource after a period unless a qualifying relative is living there. If there's no spouse, minor child, or disabled child in residence, the home can shift from exempt to an asset you might need to liquidate or justify keeping under state rules. The other big risk is estate recovery. Medicaid can't always count the home up front, but federal law requires states to seek recovery from your estate after your death for benefits paid after age 55, including nursing home and certain home and community-based services. That's where liens and claims come in. States often place a lien during your lifetime that becomes collectible at death, or they file a claim against the estate. If your home passes through probate, the state can assert its recovery. If you have a surviving spouse, recovery is typically delayed until their death, but it's not automatically waived. Some states also pursue recovery against non-probate transfers unless specific deed types or trusts prevent it under state law. Let me connect this to the penalty conversation. Even if your home is exempt while you're alive, a look-back penalty can force private pay while you're ineligible. If you don't have cash for those months, families often turn to home equity, selling the house, taking a reverse mortgage, or borrowing against it to cover the gap. That's not Medicaid seizing the house. It's the penalty pushing you to turn equity into cash. Avoiding or curing penalties is one of the most practical ways to protect your home from being used as the emergency ATM. State differences matter here. Home equity caps vary, sometimes by hundreds of thousands. Some states aggressively pursue estate recovery from expanded estates or certain non-probate transfers. Others are narrower. A few states allow hardship waivers that can reduce or delay recovery if loss of the house would cause undue hardship to heirs living there. But you usually have short deadlines and heavy documentation to claim a hardship waiver. Don't assume you qualify. Confirm first. When does the home stop being exempt? If you're single, permanently institutionalized, and there's no intent to return and no qualifying relative in the house, expect pressure to treat the home as an available asset. If you rent it out, the net rental income can impact your income budgeting, and the property could be scrutinized for being a countable resource, especially if it's not your principal residence anymore. If you transfer the house to kids within 5 years, that's usually an uncompensated transfer that triggers a penalty, unless you qualify for a specific exception. Let's hit the big exceptions briefly, so you can see the contours. Transfers to a spouse are allowed. Transfers to a disabled child or into a trust for a disabled child are allowed. The caregiver child, exception can allow a transfer to a child who lived with you and provided care for at least 2 years that kept you out of a facility, documented with logs, medical notes, and proof of residency. There's also a sibling with equity exception in some states if a sibling co-owned the home and lived there for a set period. These are technical and documentation heavy, but they're real paths that protect the house without penalty when done correctly. The silent gotcha is titling games. Adding a child to the deed as joint tenant can be a transfer of an interest and trigger a penalty. Deeding the house into certain irrevocable trusts can protect it after the 5-year seasoning, but the funding itself starts that clock and must be done without retained powers that make it countable. Life estate deeds and enhanced life estate deeds can help with probate avoidance and, in some states, estate recovery positioning, but the remainder, interest transfer for standard life estates, can be penalized if done inside 5 years. Timing is everything, and Lady Bird deed availability and recovery treatment are state-specific. Here's your quick win. If you're married, confirm the community spouse protections in your state and keep the home in their name if advised. If you're single, don't transfer the house casually. Get a state-specific elder law review. Document your intent to return if that's genuine. Keep property tax bills, utility statements, and homestead or primary residence status current. And build your penalty plan first, because keeping the house exempt won't stop a penalty from forcing you to spend its equity to cover care. What counts as a gift versus allowed transfers? Let's get precise about what Medicaid calls a gift, because names matter here. Medicaid's term is uncompensated transfer, which simply means you gave away value and didn't get fair market value back. That includes outright gifts, bargain sales, for giving a loan without repayment, and paying someone for services without a bona fide contract, and invoices. If the value went out and there's no equal value documented back, that's a gift in their book. The thing most people miss is how broad gift really is. Write a $10,000 check to a grandchild, gift. Sell a $12,000 car to your son for $1,000. Medicaid treats the $11,000 difference as a gift. Forgive a $20,000 IOU because it's family. That's a gift. Hand your neighbor caretaker $1,500 a month as thank you money without a written agreement that sets an hourly rate, logs, and invoices, likely a gift. Even moving money into a joint account your child can use freely can look like a gift if funds leave for their benefit. Now, what's allowed? Transfers to a spouse are allowed. Period. That's one of the key protections. Transfers to a blind or disabled child, or into a trust solely for the benefit of a disabled child, are allowed. The caregiver child exception can allow you to transfer your primary residence to a child who lived with you for at least 2 years immediately before institutionalization, and provided care that kept you out of a facility if you can prove both the residency and the care. There's also a sibling with equity exception in many states. If a sibling has an equity interest in the home and lived there for at least 1 year before institutionalization, a transfer can be allowed. These are technical, but powerful when documented. What about fair market exchanges? Those are not gifts. If you pay a fair price for services and have documentation, like a caregiver agreement signed before services start, an hourly rate comparable to local market rates, weekly logs, and monthly invoices, that's compensation, not gifting. If you rent a room to a family member at market rent with a lease and rent actually paid, that's not a gift. If you sell property at fair value and can show listings, evaluation, or a dealer quote, that's fine. The paper trail is everything here. Charitable giving confuses people. If you've given $100 monthly to your church for 15 years and it's modest relative to your income, many states may consider that a consistent pattern and not penalize it. But a sudden $10,000 donation inside the look-back with no history can be treated as a gift. The pattern matters. Long-standing, consistent, and modest is safer than sporadic and large. When in doubt, keep proof of your giving history and expect scrutiny. Documenting intent and consideration is the shortcut nobody teaches. For loans, use a dated, signed promissory note with a clear repayment schedule and interest that complies with state rules. Then show actual repayments hitting your account. For services, sign a contract in advance, pay by check, and keep logs. For asset sales, save valuations and closing statements. If you remember nothing else from this section, remember this: Medicaid believes the document over the story. Write it down before the money moves. Let me give you a quick example you can try today. If you're paying a daughter to help with care, draft a caregiver agreement now with an hourly rate based on local agency rates, define tasks, set hours, and start logging time daily. Pay via check or bank transfer with memo lines referencing invoices. File those invoices with the logs. Same work, different result. Now it's compensation, not gifting. Now, you might be thinking, can we fix past transfers by calling them loans? Only if the facts support it. Backdating a note won't fly. But if you truly intended a loan and can show messages, prior notes, or repayments, you may be able to recharacterize with a formal note going forward. That's a case-by-case call, and you need counsel to assess your state stance. Here's where families slip: adding a child to a bank account as a co-owner instead of authorized signer. If they spend from that account for their own needs, those outflows can look like gifts. Keep ownership clean. If you want help paying bills, use view-only access or make them an authorized signer while keeping the funds clearly yours. And one more important line: funding an irrevocable Medicaid Asset Protection Trust is a transfer for look-back purposes and starts the 5-year clock. That's expected. It's not a penalty by itself. It's planning that matures after 5 years. Fund it correctly. Don't retain control that makes assets countable, and start the clock early. If you're weighing what's safe, think in 3 buckets. Bucket 1, always allowed spousal transfers, disabled child transfers. Bucket 2, conditionally allowed caregiver, child, and sibling with equity, but only with strict proof. Bucket 3, scrutiny magnets, cash gifts, bargain sales, forgiven loans, under-the-table caregiver payments, sudden large donations. Keep gifts out of Bucket 3 once you're within 5 to 7 years of potential care. Shift support into formal, fair market arrangements. That's how you stay generous without tripping the penalty wire, undoing the damage, cures, returns, and partial fixes. Okay, so you've already made gifts inside the look-back. Now what? The fastest fix is a return of the gift. If the recipient gives back the full amount, you've effectively reversed the uncompensated transfer. Medicaid recalculates on the now zero gift, and the penalty can be eliminated. The key is proof: bank statements showing the money coming back to you, plus a written statement explaining the return and referencing the original transfer. Can't get all of it back? Partial returns still help. Medicaid recalculates the penalty on the net uncompensated amount. If you gifted $50,000 and your daughter can return $20,000, the penalty is based on $30,000, not $50,000. That can shave months off your ineligibility, which is real cash saved. Timing matters. Submit the return proof before or during your application review, not months later. Caseworkers need a clean paper trail to adjust their math. Now, what if the recipient doesn't have cash to return, but can repay over time? This is where promissory notes and private annuities may help if your state allows them and the terms meet Medicaid compliance standards. With a promissory note, you document the debt with a written agreement, level monthly payments, and no balloon payment. Interest has to be reasonable, and the term must not exceed your actuarial life expectancy. Then actual payments must begin immediately. That turns a penalized gift into an income stream that you can use to pay for care during the penalty period. If the structure isn't compliant, balloon payments, irregular schedules, or no interest, it can be treated as another transfer and make things worse. Private annuities can serve a similar purpose in some states, converting a lump sum into a stream of income. But the annuity must be irrevocable, non-assignable, actuarially sound, and provide equal monthly payments with no deferral. State interpretations vary, and some states disfavor private annuities. Don't do this without counsel who works these cases locally. Done right, these tools can plug the private pay hole during the penalty months and keep you from touching home equity. Recharacterizing past transfers as loans or compensation can work, but only if the facts support it. If you truly intended a loan, you'll need contemporaneous evidence, emails discussing repayment, prior notes, partial repayments already made. Draft a formal note now and begin real payments. For caregiver payments, if services were provided and rates were reasonable, you might formalize a retroactive caregiver agreement and match prior checks to time logs. Some states allow this with strong evidence, others are stricter. Backdating paperwork without proof won't fly. Here's where many families get traction: pairing a partial return with a clean spend down. Suppose you face a 5-month penalty. A child returns part of the funds, shrinking it to 3.5 months. You then spend down remaining assets on allowable items: dental, hearing aids, vision, mobility equipment, home safety upgrades, and prepaid irrevocable funerals, so you're financially eligible when you file. The penalty then runs while you've minimized countable assets, and the shortened private pay window becomes manageable without selling the house. Negotiating with caseworkers isn't adversarial. When you're organized, present a timeline: original transfer date and amount, the return date and amount, the updated penalty math using the state divisor, and supporting statements. Include explanations for anything that looks odd: cash withdrawals tied to invoices, valuation proof for asset sales, and signed caregiver logs. Make their job easy. If something is ambiguous, propose a reasonable classification and back it with documents. What if the recipient refuses to return anything? You're not stuck, but your options narrow. You can still mitigate with compliant notes or annuities if viable. Tighten documentation around any transactions that might be reclassified as compensation, and time your application so the penalty starts when you're already at asset limits. You might also explore hardship exceptions in rare cases, but approvals are limited and evidence-heavy. A quick micro story: a client had gifted $40,000 across 2 years. We secured a $15,000 return, drafted a compliant promissory note for $25,000 with 18-month equal payments, and aligned the application after spending down on dental work and a ramp. The state recalculated the penalty on $25,000, and the note payments covered most of the private pay gap. No home sale. The difference was documentation and timing. Here's your action list. Call the gift recipients today, explain the Medicaid penalty math, and request a full or partial return. If that's not possible, speak with an elder law attorney about a compliant promissory note or annuity. Gather bank statements, invoices, and any evidence that supports loans or caregiver compensation. Then align your application to the moment you're financially eligible, so whatever penalty remains runs with the least damage. Legal strategies to protect the home and qualify. Now that you know how penalties work and how to cure them, let's build the protection plan that keeps your house safe and gets you eligible on time. We'll walk through the tools that actually work when they're done correctly and early enough. Start with the Irrevocable Medicaid Asset Protection Trust, often called a MAPT. Why use it? Because once assets sit in the trust for 5 years, they're typically outside your countable estate for Medicaid and protected from estate recovery in many states. Here's what it is. you create an irrevocable trust, name a trusted child or third party as trustee, and transfer non-retirement assets into it, often the home and sometimes brokerage assets. You keep the right to live in the house and collect trust income if structured correctly, but you don't keep control to take principal back. The reason this works is the 5-year seasoning clock. Funding the trust starts the clock. After 5 years, those assets usually aren't penalized and, if drafted to avoid probate, often bypass estate recovery. The tricky part is drafting. Retain too much control and the assets become countable. Use an experienced elder law attorney. Small drafting mistakes can blow the protection. The game changer nobody talks about is fund early, fund correctly. People set up a MAPT and forget to actually deed the home or retitle the account. No funding, no protection. Get recorded deeds, updated beneficiary designations where appropriate, and written confirmations from financial institutions. Then keep the trust books clean, no commingling. Next, life estate deeds and enhanced life estate deeds, often called Lady Bird deeds in certain states. A standard life estate deed gives you a life interest and transfers the remainder to your heirs now. That remainder transfer is a gift, which can trigger a penalty if done inside 5 years. But an enhanced life estate deed, where available, lets you keep the power to sell or mortgage during life and transfers automatically at death, often avoiding probate and sometimes limiting estate recovery. The why. In many states, the property doesn't pass through your probate estate, so recovery can be harder. The how. You sign the deed now, it records now, but you keep control during life. The caution. Rules are state-specific. Some states don't recognize Lady Bird deeds, and treatment for recovery can vary. Get local guidance before you record anything. Now, the caregiver child exception. If your adult child lived with you for at least 2 years immediately before institutionalization and provided care that kept you out of a facility, you can transfer the home to that child without penalty. That's huge, but you need proof: the child's residency, tax returns, driver's license, lease, mail, care logs showing tasks and hours, medical notes saying their care delayed institutionalization, and ideally statements from a physician. The thing most people miss is the kept you out of a facility piece. You need evidence that without the child's help, you would have been placed earlier. Build the documentation as you go, not at the end. Let's hit spousal strategies. Transfers to a spouse are allowed. The Community Spouse Resource Allowance, CSRA, lets the well spouse keep a state-determined amount of countable assets. With good planning, you can shift excess into the community spouse's name, use spousal-only annuities in some states, and convert countable assets into exempt ones the spouse can retain, where it's allowed. Spousal refusal can be a strategy. The community spouse legally refuses to contribute assets, forcing the state to determine eligibility for the institutionalized spouse, while the state may pursue the refusing spouse separately. It's technical, controversial in some places, and very state-specific. Don't try this without. Counsel who does it regularly. Name on title decisions matter. If you're married, keeping the home solely in the community spouse's name can streamline eligibility and reinforce the exemption while you're in care. But don't retitle within 5 years without advice. Some changes can look like transfers or trigger estate recovery issues later. Tie title planning to the broader strategy so you don't create accidental gifts. Here's a clean blueprint for a typical homeowner 5 to 10 years out. Audit assets, stop casual gifting, create and fund a MAPT with the home and select non-retirement accounts, update powers of attorney and HIPAA releases, and keep pristine records. If you're closer, say within 2 years, consider whether an enhanced life estate deed is recognized and helpful in your state. Evaluate caregiver child potential if a child is already providing care, and align spousal strategies to maximize the CSRA. What about annuities and promissory notes as planning tools, not just cures? In spousal cases, a Medicaid-compliant annuity can convert excess countable assets into an income stream for the community spouse, helping the institutionalized spouse qualify. The annuity must be irrevocable, non-assignable, actuarially sound, and pay in equal installments, with the state named as remainder beneficiary to the extent required. In single cases, these tools are more limited and riskier. Always check state policy and recent case law. A quick micro story. A widow funded at MAPT with her home and savings 6.5 years ago. When she needed care, the home stayed protected, no penalty applied, and because the trust avoided probate, estate recovery didn't touch the house. Her daughter sold the home a year later from the trust and used proceeds per the trust terms. The why it worked was early funding, clean drafting, and no retained powers. If you remember nothing else, protection isn't one document. It's timing, correct funding, and state-specific execution. Start the 5-year clock early. Use the right deed for your state, document caregiver exceptions, and for couples, maximize spousal protections first. That's how you keep care funded and the roof in the family. The pre-crisis roadmap, what to do 5 to 10 years out. This is the calm window when small moves create huge protection later. Think of it as building your fire break before any sparks. We'll map risk, move assets the smart way, set the legal scaffolding, and replace casual gifting with clean, documented arrangements so the 5-year clock works for you, not against you. Start with a baseline financial audit. Pull 5 years of bank and investment statements, property deeds, vehicle titles, loan documents, and a list of recurring transfers. Create 3 columns: exempt, countable, and risky. Exempt usually includes your primary residence within equity limits, 1 vehicle, personal effects, and certain prepaid, irrevocable funerals. Countable often includes checking, savings, brokerage accounts, non-qualified annuities, cash value life insurance above small exemptions, and second properties. Risky are the things that look innocent but trip penalties, casual gifts, forgiven loans, bargain sales, and under-the-table caregiver payments. Now build a risk map. Ask, if I needed care within 5 years, which transactions would be questioned? Flag any transfers to family, cash withdrawals without receipts, app payments, and property value changes. This isn't to scare you, it's to give you a clean starting line. Once you see the pattern, you can stop feeding it. Next, move assets thoughtfully. Prioritize the home. For many families, the house is the biggest target for estate recovery, and for emergency private pay if a penalty hits. 2 strong paths here: an irrevocable Medicaid Asset Protection Trust, or, in states that recognize it, an enhanced life estate deed. The trust is the deeper shield. You transfer the home and select non-retirement assets into the MAPT. You keep the right to live there and potentially receive income, but you give up access to principal. Funding starts the 5-year clock. After 5 years, those assets are typically not penalized and often avoid probate-based recovery. The deed is simpler. You keep control during life and it passes automatically at death, often sidestepping probate, but it doesn't remove the house from look-back if you're within 5 years. Choose based on your timeline. 5 to 10 years out favors the MAPT. Closer in planning may lean on deed mechanics where allowed. While you're at it, get the legal tool set in place. Update durable financial powers of attorney with robust gifting and trust provisions tailored to Medicaid planning. Add HIPAA releases so your agents can access medical information. Establish healthcare proxies and living wills. If you plan to use a MAPT, sign it, fund it, and keep the trust books separate. If you're married, review beneficiary designations and titling to maximize the community spouse's protections and avoid accidental transfers that restart clocks. Now stop risky gifting. Replace casual generosity with formal, fair value arrangements. If a child helps with care, create a caregiver contract with market rates, define tasks, logs, and invoices. Pay by check with memos tied to invoices. If you support a family member, consider a real loan with a signed promissory note, reasonable interest, and actual repayments. If you rent space to family, use a lease and collect market rent. Consistent charitable giving can continue if it's modest and long-standing. Keep proof. The theme is simple: document consideration before money moves. Clean records are a strategic advantage. Build a documentation kit. 5 years of statements, deed copies, valuation snapshots for big sales, caregiver contracts, time logs, invoices, receipts, and any loan notes with repayment evidence. Create a one-page timeline of major transactions with a short explanation and supporting documents bookmarked. When a caseworker can follow your paper trail in minutes, uncompensated transfer, disputes drop fast. As you shift assets, be careful with retirement accounts. Traditional IRAs have tax consequences if liquidated. Coordinate withdrawals with your CPA to avoid ugly tax bills that don't help eligibility. For life insurance with cash value, get current statements. Partial surrenders or exchanges may be part of a spend down later. Don't move anything just to move it. Decisions should fit a state-specific plan. Here's a practical sequence you can follow over 90 days. Month 1, do the audit, categorize assets, and freeze casual gifting. Month 2, meet a local elder law attorney. Decide on MAPT versus deed. Draft updated powers of attorney and health directives, and gather funding paperwork. Month 3, fund the trust or record the deed as advised. Set up caregiver or loan documents if needed, and assemble your documentation kit. From there, maintain clean books, keep routine charitable giving consistent, and calendar your 5-year trust seasoning date. A quick micro story. A couple in their early 70s funded a MAPT with their home and a taxable brokerage 6 years before he needed care. They stopped gifting, moved daughter's support into a small documented loan, and set up a caregiver contract for mom's health. When placement came, there was no look-back penalty. The trust assets stayed off the table, and probate recovery never touched the house. The difference wasn't a fancy trick. It was early funding, clean paperwork, and no mixing. 2 final checkpoints. First, verify your state's home equity limit and penalty divisor annually. Rules and numbers change. Second, review your plan every year and at any major life event. Sale of property, death of a spouse, health shift, or moving states, which can change rules and divisors. Planning isn't one and done. It's maintenance. If you remember nothing else, start the 5-year clock while you're healthy, formalize any money that changes hands, and keep proof for everything. Do that, and when a crisis comes, you'll already have the answers the caseworker needs. The crisis plan, if you need care in 6 to 18 months. If you're within 6 to 18 months of needing care, you don't have time for theories. You need a tight plan that stops the bleeding and positions you for approval. First move, freeze all non-essential transfers today. No gifts, no helping out, no bargain sales. Every dollar out without fair value can extend a penalty you can't afford. Tell family there's a temporary stop so you can qualify. Next, contain the damage you already did. Pull your 5-year transaction list and highlight anything risky. If a recipient can return funds quickly, ask for a full or partial return and document it cleanly, bank to bank with memos referencing the original transfer. If returns aren't possible, talk to a local elder law attorney about a compliant promissory note to convert some of that exposure into a payment stream you can use during any penalty period. Don't draft notes casually. Terms must be level, actuarially sound, and start immediately. Now we shift into high-value spend down. Convert excess countable assets into things that improve your quality of life and are allowed. Think dental work, hearing aids, eyeglasses, mobility devices, and home safety upgrades like grab bars, ramps, better lighting, and shower modifications. replace a failing roof, or HVAC if needed. Prepay an irrevocable funeral and burial plan at reasonable cost. Buy clothing, shoes, and personal items you'll use. If your vehicle is old, upgrading to one reliable car within program limits can be allowed. Keep every receipt and invoice. These aren't loopholes. They're legitimate, life-improving uses of your money that bring you to the asset limit without waste. Before we continue, you need to understand conversion. The goal is to turn countable assets into exempt ones. If you're married, align purchases to benefit the community spouse, necessary home repairs, medical and dental care, and items they'll keep. In some states, a Medicaid-compliant annuity for the community spouse can convert excess assets into an income stream for them, accelerating eligibility for the spouse applying. This is technical, yet state-specific guidance, so the annuity is irrevocable, non-assignable, actuarially sound, and pays in equal installments. Now, let's talk structured gifting with a cure plan. In a tight window, new gifts usually hurt. The only time to consider a structured transfer is when you can pair it with a documented return or a compliant note, immediately creating a predictable cash flow to cover the penalty months. If the cure mechanism isn't rock solid, don't do it. The thing most people miss is that we'll figure it out later becomes we're privately paying and out of options. Apply at the right moment. Benefits don't start until you are medically eligible, financially eligible, and you've filed a complete application. The clock on any penalty starts then, not before. So your sequence looks like this. Complete spend down with receipts, finalize any gift returns or notes, assemble 5 years of statements and your documentation kit, confirm a placement plan, and then file. Filing early with loose records or excess assets creates delays and forces extra private pay time. Here's a micro timeline you can copy. Weeks 1 to 2. Stop transfers, audit 5 years, request returns, schedule medical/dental visits, price home safety upgrades, and book funeral planning. Weeks 3 to 6. Complete purchases and repairs, lock annuity or note strategies if advised, and compile receipts. Weeks 7 to 8. Reconcile bank balances to the asset limit, print all statements, label every risky transaction with an explanation and proof, and coordinate facility availability. Week 9. File the application with a clean packet and a cover summary that maps your transactions to documents. This pace keeps the process moving without sloppy gaps. Now, the private pay bridge. If you're facing a penalty, calculate your exposure using your state's divisor and decide how to cover the gap without selling the house if possible. Sources can include returned gifts, payments from a compliant note, short-term family loans to you, not vice versa, and if absolutely necessary, a home equity line already in place before you apply. Avoid last-minute new liens or unconventional loans that look like asset sheltering. Common mistakes to avoid: paying family caregivers without a written agreement and time logs, selling assets quickly to relatives at a deal price, forgetting to disclose digital transfers, and filing without 5 full years of statements. Also, don't switch banks midstream unless necessary. It complicates the paper trail. If you closed accounts, retrieve those old statements now. Negotiating with the facility matters. Be transparent about your timeline. Share that your Medicaid application is filed and provide updates. Many facilities will hold placement or work with a short private pay period if they see a credible plan. A bed hold agreement or short-term contract buys breathing room while the case processes. One more high-value move: get powers of attorney and HIPAA releases updated if they're weak. You need agents who can request records, sign contracts, and respond to caseworker questions fast. Slow signatures cause avoidable denials and reapplications. Your quick win today: list 3 allowed spend-down items you can schedule this week: dental, hearing, and home safety, and book them. Then call the largest gift recipient to request a partial return and explain that every dollar back cuts penalty months. Finally, email a local elder law firm to confirm your state's divisor, partial month rules, and whether compliant notes are effective in your county. Fast action here saves real money. The 7 most expensive mistakes families make. Let's pressure test your plan by walking through the 7 mistakes that cost families the most money, time, and too often their home equity. Mistake 1. Believing the IRS gift exclusion protects Medicaid eligibility. The IRS rule is a tax filing rule. Medicaid asks, did you transfer assets for less than fair market value? If yes, it's penalized, even if the gift is under the annual tax exclusion. The fix: stop relying on tax thresholds. Build your 5-year transfer inventory and classify each item by whether you received fair value back with proof. Mistake 2: paying family caregivers under the table without a written agreement. Caseworkers reclassify those payments as gifts because there's no proof of services or rates. The fix: sign a caregiver contract before services start, use a market hourly rate, keep daily logs and monthly invoices, and pay by check with memos that match the invoices. If you've already paid, informally gather calendars, texts, and notes, then talk to counsel about whether your state accepts retroactive agreements with strong evidence. Mistake 3: titling the house to kids within 5 years. A deed transfer to a child is almost always an uncompensated transfer unless you meet a narrow exception like the caregiver child or sibling with equity rules. That deed can trigger months of ineligibility and force private pay that drags you back to home equity anyway. The fix: don't transfer the house casually. If you need protection, use a MAPT 5+ years out, or, where recognized, an enhanced life estate deed with state-specific guidance. If the deed already happened, explore a return to grantor deed to cure or build a partial cure strategy. Mistake 4: filing the application before you meet the asset and income limits. Early filing doesn't preserve a spot. It starts scrutiny. If you're over the cap, you'll drain assets while any penalty runs, which is the worst of both worlds. The fix: complete spend down first on allowable items, secure any gift returns or compliant notes, assemble 5 full years of statements, and apply only when the numbers already fit. Mistake 5: missing digital transfers in disclosures. Zelle, Venmo, Cash App, PayPal, and bill pay to individuals all show on statements. Unexplained entries are magnets for penalty findings. The fix: print app histories, annotate each transfer with who, what, and why, and attach proof, receipts, invoices, loan notes, or payback evidence. If you used cash, tie withdrawals to dated receipts. Every dollar needs a story with paper. Mistake 6: ignoring estate recovery notices and deadlines. You may qualify while alive, but the state can recover costs from your estate after death. Miss a notice or deadline, and you lose rights to hardship waivers or exemptions. The fix: designate a point person, usually your executor or trustee, to monitor mail after death, calendar response deadlines, and file hardship or exemption claims with documentation. Better yet, plan during life so the home avoids probate, where that helps in your state. Mistake 7: DIY planning without state-specific counsel. The rules are federal plus state, and small differences change outcomes. Partial month rounding, divisor updates, treatment of notes and annuities, ladybird deed. Availability, and spousal refusal policies. Copying a friend's strategy from another state can add months of penalties. The fix: get a local elder law attorney who files Medicaid cases weekly. Ask them 3 things up front: your state's current penalty divisor, partial month rule, and stance on promissory notes and private annuities. Now, a few high-impact mini avoids inside these mistakes. Don't make just one last gift in the months before filing. It stacks and extends penalties. Don't sell assets to relatives at a discount. Medicaid treats the discount as a gift. Don't move money into joint accounts your child uses. Outflows for their benefit look like gifts from you. Don't rely on vague caregiver stipends. Use contracts and logs. And don't assume your home is safe just because it's exempt. Penalties force private pay. That often pulls from home equity. Quick wins you can knock out this week. Get a written caregiver agreement in place if family is helping. Pull 5 years of app transfer histories and annotate them. Call your state or check the website for the current penalty divisor and partial month rule. And schedule one allowable quality of life spend down item, dental, hearing, or home safety. If you remember nothing else from this section, remember this: Medicaid doesn't forgive paperwork gaps. The document beats the story every time. Turn generosity into formal exchanges, fix what you can with returns or compliant notes, and file when eligibility math already works. That's how you avoid the 7-cost trap. Mini case studies, how the math plays out. Let's lock this in with quick, realistic mini case studies so you can see the math, the documents, and the outcomes. Case A, $50,000 down payment gift, partial cure. 3 years ago, Maria gave her son $50,000 for a home purchase. Today, she needs nursing care. Her state's penalty divisor is $8,500. 50,000 divided by 8,500 equals 5.88 months of ineligibility. The facility charges $9,200 per month, so private pay exposure is roughly $54,000. Her son can return $20,000 immediately. The agency recalculates on $30,000. 30,000 divided by 8,500 is equal to 3.53 months. That cuts exposure by about 2.35 months, over $21,000 saved. What made it work? Clean documentation. The original wire, the return wire showing return of gift, and a cover letter mapping dates and amounts. She also spent down on hearing aids, dental implants, and a ramp before filing, so the shorter penalty ran when she already met asset limits. Case B, tuition gifts versus charitable pattern. Robert paid $1,000 monthly to a grandchild's college for 18 months, then made a one-time $7,500 donation to a new nonprofit. The state adds the tuition payments. $18,000 total, plus $7,500 for $25,500 of transfers. Divisor is $7,100, so $25,500 divided by $7,100 is equal to 3.59 months. Could anything be excluded? The consistent charitable pattern helps if it's long-standing and modest, but Robert had no giving history to that nonprofit. The tuition also counts. Medicaid doesn't have an education exception. A partial fix. The nonprofit refunded $5,000 voluntarily after seeing the Medicaid issue. New total $20,500. Penalty drops to 2.89 months. The key move was asking for a return quickly and documenting it. Case C, caregiver child exception succeeds. Denise lived with her mother for 3 years and provided daily care. Med reminders, bathing assistance, meal prep, that kept mom out of a facility. When mom entered nursing care, they wanted to transfer the home to Denise under the caregiver child exception. They proved it with Denise's driver's license showing the address, tax filings, utility bills, a physician's letter stating mom would have required institutional care at least 2 years earlier without in-home support, and daily care logs. The transfer was approved with no penalty. Outcome: mom qualified without the house counting, and there was no private pay gap driven by a home transfer penalty. The lesson is clear. The exception works when the evidence is airtight. Case D, MAPT funded 6 years ago. A widower, Sam, created and funded a Medicaid Asset Protection Trust 6.5 years before needing care. He deeded his home to the trust and moved a taxable brokerage account into it. He kept a right to live in the house and receive trust income, but no access to principal. When he applied, the trust assets were outside the look-back window. Result: no transfer penalty, because the trust avoided probate. Estate recovery did not attach to the house. Sam's checking and small savings were the only countables. He spent down on dental, vision, and prepaid funeral, then qualified. The critical steps were early funding and proper drafting that didn't retain disqualifying control. Case E, Life Estate Deed versus Standard Deed. Two sisters, both single. Anna recorded a standard life estate deed 4 years before needing care, giving her nephew the remainder interest. In her state, that remainder transfer is countable as a gift inside 5 years. Home value at transfer was $300,000. The actuarial remainder was valued at $180,000. Divisor, $9,000. That's a 20-month penalty. Outcome, she faced a large private pay gap. Her nephew couldn't return funds because he never received cash. Contrast Beth in a state recognizing enhanced life estate, Lady Bird deeds. She executed a Lady Bird deed 6 years before care. At death, the house passed outside probate to her niece, and the state didn't pursue estate recovery against that non-probate transfer. No penalty, no recovery. The difference was deed type and timing and state law. Case F, forgiven loan, recharacterized. Harold wrote his daughter $2,000 checks every month for a year memo loan, but never documented terms. Total $24,000. The state treated it as a gift. Divisor $6,800 makes it 3.53 months. His attorney gathered texts where they discussed paying him back, then drafted a promissory note with level payments beginning immediately. The agency accepted the note going forward, but didn't erase past transfers. However, the monthly repayments became income Harold used during the penalty months, reducing the private pay hole. Not perfect, but better than nothing. Case G, vehicle sale at a family price. Linda sold a car with a blue book of $12,000 to her grandson for $2,000. The $10,000 gap was treated as a transfer. Divisor $8,000 equals 1.25 months. She avoided the penalty by documenting a later $8,000 repayment from the grandson after they understood the rule, plus an independent valuation to confirm fair value. Again, the cure was fast action and proof. Your pattern here: know the divisor, add the transfers, calculate the months, and then either cure, shorten, or structure cash flow to bridge the penalty. Every win came from documents, timing, and using the right exception or tool for the state. Your Medicaid Look Back Survival Checklist. Here's the checklist that turns anxiety into a plan. Keep it simple, keep it documented, and move in this order. First, run a 5-year transaction audit. Pull bank, brokerage, and credit union statements for 60 months. Add app histories: Zelle, Venmo, Cash App, PayPal, and bill pay to individuals. Flag checks to family, cash withdrawals without receipts, loan repayments without notes, and bargain sales. Create a running list with date, amount, recipient, and purpose. Next to each, mark one of 3 boxes: fair value received, questionable, or uncompensated. Your goal is a total of uncompensated transfers. That number drives the penalty math. Second, lock down your home protection choice. Decide with a local elder law attorney whether a Medicaid Asset Protection Trust or a deed strategy best fits your timeline and state rules. If you're 5 to 10 years out, a properly drafted and funded MAPT usually offers stronger protection from both the look-back and estate recovery. If you're closer and your state recognizes enhanced life estate, Lady Bird deeds that may help with probate avoidance and recovery positioning, but remember, it does not erase look-back exposure inside 5 years. Record deeds correctly and confirm funding of any trust. No funding, no protection. Third, assemble your documentation kit. You need 5 full years of statements for all accounts, including closed ones. Add property deeds, titles, and any sales contracts. Include caregiver contracts with hourly rates, time logs, and invoices. Attach promissory notes with repayment proof. Save valuations for asset sales, Kelley Blue Book for vehicles, Realtor CMAs or appraisals for real estate, and screenshots for brokerage transfers. Create a one-page index that maps each flagged transaction to the evidence that proves fair value, return of funds, or the legal exception you're claiming. Fourth, confirm your state's penalty divisor and partial month rule. Call or check your state Medicaid agency website and write down the current nursing home divisor and whether they calculate penalties to the day or round. Use your uncompensated total divided by that divisor to estimate months of ineligibility. This is your planning anchor for spend-down timing, private pay bridging, and cure strategies. Fifth, sequence your application timing. Benefits start when three things are true. You meet the medical level of care, you're financially eligible, and your application is filed. Plan your spend down so you hit the asset limit just as you file with receipts in hand. If you identified uncompensated transfers, arrange returns before filing, or implement a compliant promissory note if your state allows it. Coordinate facility availability so the penalty period, if any, runs during a window you can cover. Sixth, stop risky gifting immediately. No more small help to family, no bargain sales, no cash thank yous to caregivers. If family provides care, sign a caregiver agreement now, set a market rate, and start time logs and invoices. If you support a relative financially, consider a real loan with a written note and monthly repayments. Clean structure turns generosity into fair value. Seventh, execute allowed spend down with value. Schedule dental work, hearing aids, eyeglasses, mobility devices, and home safety upgrades. Replace critical home systems if needed. Prepay an irrevocable funeral at a reasonable cost. If married, align purchases that benefit the community spouse. Keep every invoice and receipt. These are legitimate quality of life uses of funds that also bring you to the asset limit. Eighth, build your professional team. You want a local elder law attorney who files Medicaid cases weekly, a benefits coordinator or case manager if available, and a CPA to coordinate any tax impacts from asset moves or retirement withdrawals. Ask your attorney 3 specifics up front: the current divisor, partial month practice, and your state's stance on promissory notes and private annuities. Ninth, prepare a cover letter for the application. In one page, summarize assets, spend down items with totals, your 5-year transfer list with cures or documentation, and your penalty math using the state divisor. Attach the indexed packet, make the reviewer's job easy, and you cut delay risk. Finally, set maintenance habits. Each month, file receipts, update your transaction log, and keep caregiver timesheets current. Once a year, verify the divisor, revisit your plan after major life events, and avoid new gifts. If you remember nothing else, remember this: the document beats the story, and timing beats wishful thinking. Follow this checklist, and you'll keep care funded without sacrificing the house. Rapid fire Q&A, state variations, and edge cases. Do small recurring gifts to grandkids trigger penalties? Yes, if they happen within the look back, and there's no fair value back. There's no under $17,000 Medicaid. Exclusion, that's a tax rule. One nuance: long-standing, modest gifts that match your historical pattern may get less scrutiny than sudden, large transfers. Still, expect to document everything. Can I sell my home during look back and keep the proceeds? Selling at fair market value isn't a gift. If you get full fair value and can prove it, listing history, CMA or appraisal, HUD, one, and deposit trail, the sale itself isn't penalized, but the proceeds become countable assets. You'll likely need a spend down plan, and if you gift the proceeds, you'll create a penalty. What if the gift was for medical bills or education? Medicaid doesn't carve out an education or standard medical bill gifting exception. Payments for your own medical expenses are fine. Paying someone else's expenses is still a transfer for less than fair value. If a school or hospital can refund, a return may cure or reduce the penalty. How do divorces and second marriages change the rules? Marital status and timing matter. At application, Medicaid looks at the couple's combined countable assets for spousal protections, even in many second marriages. A late-in-life divorce to qualify can create legal and financial fallout, and states scrutinize it. If you're already divorced, only your assets count, but prior transfers are still reviewed within look-back. What happens if the recipient refuses to return the gift? You still have options, partial cures from any recipient who can help, a compliant promissory note if your state accepts it, and precise timing. So the penalty starts when you're at the asset limit. Document your attempts to recover funds. It won't erase the penalty, but it shows good faith and supports any hardship arguments. Can I transfer my home to a disabled child without penalty? Yes, transfers to a blind or disabled child, or to a trust for their sole benefit, are allowed. You'll need proof of disability status and clean transfer documents. This is one of the strongest exceptions when done correctly. Does every state use the same penalty divisor? No. Each state sets its own average monthly nursing home rate and updates it periodically. Some calculate penalties by the day, others round. Always confirm your state's current divisor and rounding practice before you file. Are Lady Bird deeds recognized everywhere? No. Only certain states recognize enhanced life estate deeds. Where recognized, they can help avoid probate and limit estate recovery. Where not recognized, you'll need other tools, trusts, beneficiary deeds, or state-specific strategies. What if I gave to charity? If it's a long-standing, modest pattern relative to your means, many states treat it more leniently than sudden, large donations. Big spikes inside look-back are risky. Keep receipts and show your multi-year pattern. Can I move to a different state with better rules? You can, but moving late introduces residency and timing issues. You'll need to establish domicile, meet that state's eligibility, and still face the federal look-back framework. It's not a shortcut. Is paying a family member as a caregiver safe? It can be if you do it right. Signed agreement before services, market rate, time logs, monthly invoices, and payments by check that match invoices. Without that, it's usually treated as gifting. Will Medicaid put a lien on my house? States can place a TEFRA lien in some circumstances and pursue estate recovery after death for services paid after age 55, subject to spousal and hardship rules. Exempt during life doesn't always mean exempt from recovery later. One last edge case: forgiven loans. If you genuinely had a documented loan and forgave it, the forgiven amount is an uncompensated transfer. If you didn't document it, the original loan likely reads as gifts. Either way, expect scrutiny. Here's the takeaway: generous, innocent gifts can turn into months of Medicaid ineligibility, private pay gaps, and pressure to tap home equity, unless you plan, document, and time everything. Download the checklist, pull 5 years of statements this week, and book a consult with a local elder law attorney to map your divisor and cures. Want the exception playbook that can save you even after gifting? Watch the follow-up video next, and move now while you still control the timeline.